Level 4, Chapter 2. One type of financial ratios that can be used for analysis is called market-based ratios. Market-based ratios incorporate values which change according to how the market changes. Thus, they overcome the limitations of ordinary financial ratios, which are based on screenshot or book values that are released once in 3 months. The most widely used market-based ratios are price-earnings, PE ratio, equals market price of stock divided by net profit, which is calculated by dividing the market price of a given company's stock by the last period's profit figure. A high PE indicates investors believe the company will grow in the future. Book-to-market ratio equals book value divided by market value, which is calculated by dividing the book value by the market value of a company. A low book-to-market ratio indicates that the market perceives the company as more valuable than its financial statements show. Benchmarking and industry averages. Both ordinary and market-based financial ratios do not mean anything unless they're compared to a benchmark. Usually, when a company is analyzed, we compare its ratios to the ratios of competitors or to the average ratios of the industry. Only thus can a trader judge whether or not a company is in a good shape and its stock is a good investment. Horizontal analysis. We can complement our ratio analysis by simply measuring the rate of change of entries in the financial statements from one period to the next. For example, we can measure how much fixed assets have changed in percentage terms during the last 5 consecutive accounting periods. Discounted cash flow, DCF analysis. Along with CAPM, DCF is one of the most widely used models for predicting the price of a stock. Free cash flows are what investors and managers can use either for profit or for reinvestment. Therefore, calculating the free cash flows that are going to occur in the future should yield the fair value of the company's stock. Cash flow analysis projections are done by jointly using fundamental and econometric analysis. Then, we calculate the value of the stock by discounting the cash flows by the cost of capital of the company, called WACC, which is the percentage the company pays for dividends and interest rate. The process is shown by the illustration on the right. Candlestick formations. Candlestick patterns are used by predictions over short-term trades. Candlesticks are derived by monitoring a standard bar chart. Candlesticks shows complicated interactions between buyers and sellers. Candlestick charting provides insight into the volatility on financial markets. It not only shows how big volatility was, but also how volatility evolved within a certain period. Candlesticks are thus very helpful for assessing a trader's optimal timing for buying and selling. Long days. A long day represents a large price movement for the day, high volatility. In other words, the open price and the close price were considerably different. Short days. Based on the same methodology as long days, short days shows low volatility, especially when the shadows are small. Sequences of consecutive long days or short days can reveal whether the market is calm or uncertain. Closing Marubozu. Closing Marubozu has no shadow extending from the close end of the body, whether the body is white or black. The black closing Marubozu is considered a weak line, and the white closing Marubozu is a strong line. It is considered a buy signal. Opening Marubozu. The opening Marubozu has no shadow extending from the open price end of the body. The black opening Marubozu with no upper shadow is a weak and therefore bearish signal. Doji. The doji represents indecision in the market when the market is in a trend. A doji is a signal that a trend might be approaching its end or that it does not have potential to form. Long-legged doji. Long-legged doji tend to be better at indicating a change of trend when they occur at tops instead of at bottoms. Gravestone doji. If the upper shadow is quite long, it means that the gravestone doji is a strong sell signal. Morning star, evening star. The morning star is a 3-day pattern. The first day is a downtrend with a long black body. The next day opens lower with a doji that has a small trading range. The last day closes above the midpoint of the first day. This pattern is an early indication of reversal. The mirror image of Morningstar is Evening Star.